Visa is undeniably one of the world's absolute best companies. Think about it. They operate the largest electronic payments network on the planet, connecting over 4.4 billion cardholders to 130 million merchants across more than 200 countries. But here is the multi-billion-dollar question we're answering today. Is its current stock price cheap enough to make it a great buy right now? Welcome to The Explainer. Today, we are going to perform an in-depth analysis of Visa's stock. We're tearing apart its business model, its incredible financials, and its intrinsic valuation to see if this payment giant deserves a place in your portfolio today. Here's the roadmap for our in-depth analysis today. First, the ultimate digital toll booth. Second, margins, moats, and money. Third, our deep dive into valuing Visa. Fourth, stress testing what could break it. And finally, the ultimate investment verdict. All right, part one. The ultimate digital toll booth and its business model. The structure of a four-party payment network is pure, undeniable genius. See, every single time a Visa card is swiped, tapped, or entered online anywhere on Earth, Visa earns a tiny fraction of a cent. They don't make the goods, they definitely don't sell the goods, they just own the roads. They operate the rails connecting cardholders, issuing banks, acquiring banks, and merchants. Handling roughly 270 billion transactions annually, Visa actually processes more transactions in a few days than there are stars in the Milky Way. It's a machine of almost incomprehensible scale. But here is the most crucial point of all. Visa takes on exactly zero credit or lending risk. Literally zero. When someone maxes out their card and defaults on the bill, Visa doesn't lose a single penny. The issuing bank takes that hit. It's this exact structure that separates Visa completely from a traditional bank, making them virtually immune to loan defaults. No physical inventory to worry about and absolutely no debt risk from the consumer. And this toll booth model, well, it's perfectly positioned to ride a massive multi-decade trend. Now, living in a modern city, you might feel like cash is already dead, right? But the data actually tells a completely different story. Cash still dominates over 60% of transactions in many emerging markets, and it even accounts for 20 to 30% in developed ones. The global shift from cash to digital has decades left to run, meaning Visa's total addressable market is still incredibly vast and largely untapped in places like Africa, Southeast Asia, and Latin America. Moving into part two, margins, moats, and money, the financial engine. Let's look under the hood. Get a load of these numbers because they are truly astronomical. A net profit margin of 51% places Visa among the most profitable massive companies on Earth. But seriously, look at that operating margin, over 67%. What that proves is that processing one additional transaction costs Visa practically nothing. The infrastructure is already built, it's fully operational, so every new tap or swipe is just dropping almost pure profit straight down to their bottom line. And when you're generating a return on equity of over 60%, you're looking at some exceptional capital efficiency. Normally, when you see an ROE this high, it means a company is secretly juiced up on dangerous amounts of debt. But not Visa. Their balance sheet only carries about $25 billion in debt, against a business that's throwing off over $22 billion in annual free cash flow. That is an incredibly safe coverage ratio. This dynamic is the absolute hallmark of a capital-light business. Visa generated a literal ocean of cash, $21.2 billion in trailing 12-month free cash flow. But to keep the whole global network running and growing, they only had to reinvest a tiny little puddle of about $1.57 billion in capital expenditures. When a company can grow revenue at nearly 14% a year while only plowing roughly 3.6% of its revenue back into the business, you're looking at a truly elite financial engine. Okay, part three. Valuing Visa, the deep dive. Let's figure out what this behemoth is actually worth. We'll kick off the valuation with a PEG ratio of 1.53. Now, this metric weighs the price-to-earnings multiple against the company's growth and dividends. Typically, a score below 1.0 signals that a stock is deeply undervalued. So at 1.53, we are definitely paying full, maybe even slightly rich price for Visa's quality right now. Let's pit two heavy-hitting valuation models against each other to find our intrinsic value targets. First, a traditional discounted cash flow model. If we assume growth naturally tapers down to a 3.5% terminal rate, that gives us an intrinsic value of about $325 a share. Now, if we use a market earnings value approach, which essentially assigns a fair multiple to their current earnings based on that massive competitive moat we talked about, that gives us $342 a share. Blend those two together, and we get a highly accurate weighted average intrinsic value right around $338 per share. Let's take those models and build out a realistic base case scenario. By assigning probabilities, say a 60% chance for our base case and 20% each for the bear and bull scenarios, we can see that at the current stock price of roughly $322, the expected returns are hovering right around 8 to 9% annually. Don't get me wrong, that's a solid return for sure. But it doesn't leave us a whole lot of wiggle room for unexpected bumps in the road.
And here is the rub. The math is telling us loudly and clearly that the stock is currently priced for near perfection. We are left with a razor-thin 3% margin of safety against that average intrinsic value. So if you're a value investor hunting for a screaming bargain, this just isn't it. At $322, you're buying a world-class asset, but you're buying it exactly at fair value.
Which brings us to part 4. What could break it? Let's stress test the risks.
With only a 3% margin of safety, we absolutely have to ask, what could actually disrupt this incredible machine? Right now, the market has discounted the stock by about 14% from its 52-week highs, and it's because of these specific looming threats. The biggest dark cloud is regulatory risk. The U.S. Department of Justice is scrutinizing Visa's dominance in debit networks, and the EU has already gone ahead and capped interchange fees. Throw in the fear of central bank digital currencies totally bypassing traditional card rails, plus the classic risk of a severe consumer recession, and you can totally see why some investors have taken a step back.
But we have to dig deeper. Are these threats truly existential? Will they kill the company? The data actually suggests no. Sure, a Department of Justice mandate forcing Visa to restructure its debit business would absolutely sting. It could potentially knock debit revenue down by 10 to 20%. But it would likely just be a one-time reset. Their massive credit card and cross-border revenues wouldn't even be touched. And as for those central bank digital currencies, adoption has been incredibly slow. So our in-depth analysis concludes these risks are frankly a bit overstated by the broader market. They certainly wouldn't kill Visa's core compounding engine.
All right, part 5, the final investment verdict.
Let's bring all this data together. We've got an elite company, massive margins, but a very thin margin of safety. To quote the legendary Charlie Munger, this is a wonderful company at a fair price. Therefore, our final verdict today is a firm hold, leaning heavily toward accumulating on depths. It's worth noting Visa's management is aggressively buying back their own stock. They've retired over 10% of their shares just in the last 4 years. That adds a super reliable tailwind to their earnings. But honestly, to make this a high-conviction, deep value buy, we really need a catalyst to drive the price down first. So if you are that disciplined investor who demands a 9% annualized return over the long haul, along with a real 20% margin of safety, this right here is your target entry zone, $218 to $275. If a scary regulatory headline drops or the broader market takes a dive, pushing the stock into this range without the fundamental business breaking, well, that is your giant flashing green light to start aggressively accumulating shares. It's the ultimate test of investor patience, isn't it? Do you wait on the sidelines, hoping for a market crash to hit that $270 mark? Or do you just bite the bullet, pay a slight premium today, and own a piece of the world's greatest digital toll booth right now? Basically, would you rather buy a fair company at a wonderful price, or a wonderful company at a fair price? Let us know what you think. Thanks so much for joining us for this explainer, and we will catch you next time.